This is 93 Million with Doug Andrew.
Welcome to 93 Million with Doug Andrew, where we talk about how to optimize your assets, minimize taxes, and empower the three dimensions of your authentic wealth. My name is Greg Dukowitz, your host, facilitator, and IUL specialist. And in today's show, we're talking about the stock market being overpriced and what it means to you, future taxes, and a quick update on the Kyle Busch situation. And we're joined by the OG of properly structured IUL, New York Times bestselling author, and a man who loves a good dad joke, Doug Andrew.
Good to be with you as always.
Co-author of the L.A.S.E.R Fund, and a man who claims to be better looking than his brother, Emran Andrew.
It's not just a claim. It is a mere fact.
Also co-author of the L.A.S.E.R Fund, and also claims to be better looking than his brother, Emran Andrew.
And that is a claim.
I don't know.
I'll let him have it.
Is there another brother somewhere? I don't know what's going on.
Just the two of us.
And our featured host for today, president of L.A.S.E.R Financial, not a brother, but definitely better looking, Brandon Johnson.
A brother from a different mother.
Good to have you, Brandon.
We love Brandon.
All right, excited. Have some great topics. Let's just jump in. Is the stock market overpriced? According to currentmarketevaluation.com, the current S&P 500 stock market index is, quote, strongly overvalued. Well, what does that mean? Well, it has a price-to-earnings ratio, or PE ratio, of 39.1, which is 90% above the typical average. Well, what does that mean? According to the report, the PE ratio is a classic measure of a stock's value, indicating how many years of profits at the current earnings rate it takes to recoup an investment in that stock. So if the PE ratio is 39, I'm no math wizard, but seems pretty big to me. I don't know. Just saying.
It does seem pretty big. Still trying to get my head a little bit.
I know, like exactly what that means, but it doesn't sound good.
90% above sounds like above the average is usually not a good thing.
Yeah, no matter how you slice it, it sounds just like what it says, strongly overvalued. So for example, if we look at this chart right here on the screen, we can see that before the internet bubble, just before, right at the very top where the blue is the highest there, that's the year 2000, right? The market was 3 standard deviations higher than the average, even higher than it is today at 2.3 standard deviations. So not as bad. We're not as bad as the internet bubble, but we're still pretty high, and we are well above the 2008 crash level. But maybe that's actually like a totally different comparison. That's kind of another subject. But Doug, should people be worried about the stock market, and what can they do to protect themselves?
That is a great question. And my answer is going to be sort of two parts, okay? So if the PE ratio is that high to where, if I buy this widget machine, I'll make my money back in 39 years, okay? I'll get 100%.
Based upon the earnings.
Yeah.
Right, yeah.
Why would somebody do that?
Right.
They would do it in anticipation that it's really not going to take that long.
Right.
Okay.
Yeah.
So it's overvalued. They're betting on the come. Okay.
Value rises, and then the earnings rise with it.
And so that's called being bullish on America. I think the economy is going to grow, and it's going to grow real fast, whatever. And so I'm willing to pay a higher price because even though the current earnings on this stock doesn't really justify that. Okay. Right. Now, why would people be thinking that way? Well, because I think with Trump in and many of the things that he's doing, the economy is responding. And basically where the previous administration didn't even bring in $1 trillion from tariff revenue or from foreign countries, Trump knows economics. He knows how to negotiate, and he's already responsible for bringing in probably $17 to $18 trillion. Okay, so with that anticipation, not only are investors thinking, "Wow, I want to come along for that ride," okay, and benefit from it. Even he's talking about giving everybody a $2,000, rebate from just the tariff revenue that he's received. Okay, now I think that's great. I'm somewhat bullish that the economy will be strong. Okay, now having said that, things can go south.
Right.
And so that's why I love indexing. I'm not talking about index mutual funds, okay? I'm talking about indexing, which is a strategy that we teach and use with IUL, okay? I can go for it, and based upon what's going on, I can get a return up to maybe a cap, or maybe I can go for it on a 2-year or a 5-year strategy with an IUL. But the beauty is, if I guess wrong, and we do have a downturn, or what some would say was a correction or whatever, okay, that it was way overpriced, I don't want to lose. It's okay if I don't make anything, but I don't want to lose. Because we learned in 2008, and we learned in 2001 to 2003, that if you're not protected, you can lose not just 10 or 15 or 20%, 30 or 40% in a single year. Or like March of 2020, COVID-19.
Yeah.
The market dropped in 30 days, 30%.
Right.
Now, it did come back rather quickly. So that's why I want to protect myself in case I guess wrong. And so let's go for it if you feel bullish about America. But protect yourself in case something that we don't foresee. It could be a terrorist attack. It could be something that's just out of our vision. And I don't even want to mention what some of those things could be. But if President Trump is not around for his full term for some reason, then things could go south. Okay. So that's why I like indexing, because it protects you against the unforeseen things that could cause the market to crash.
I love it. So bullish, but have protection, because none of us have a crystal ball.
Exactly.
Right? Nobody has a crystal ball.
Right.
I love that. Emron, what are your thoughts?
I mean, I think the question is, should we be concerned about the stock market? And the answer is absolutely yes. I mean, I think you should be concerned about the stock market.
When should you not be concerned about this?
Right? I mean, because again, if you're just relying 100% on the stock market. Now, I do believe, bullish. I believe the market's going to be growing. Mm-hmm. But, if you do not have a strategy in place to be able to protect you from losses during a stock market crash, then you should absolutely be scared. It's not a matter of, is the market going to crash? It's not a matter of if.
Right.
It's a matter of when.
It always has.
I mean,
it always comes back too.
Yeah, whenever you get 3 standard deviations away from the norm right there, I mean, definitely speculation. I mean, we got speculation primarily probably in AI.
Right.
A lot of speculation, and when the speculation out is over speculated the reality.
Right.
And I think a lot of people just have no idea.
Yeah, it becomes a fad.
What AI, what the ceiling or what the reality of AI is.
Right.
So that's why there's just speculation galore.
Yeah.
And it could meet all of the speculation. Maybe it does, and we're just fine. Yeah. But regardless, you should be worried if you do not have a strategy in place to be able to gain as it goes up, but protect you if or when, not if, when it finally does come back down.
Yeah, that's great. Aaron, Doug, and Emron kind of touched on indexing. What can you explain more detail? What is indexing? Like in IULs, we talk about Index Universal Life, IULs. What is indexing in that context, and how does it work? Can you give us more details on it?
Okay, I'm going to keep kind of simple here, but basically indexing is inside of an IUL, and the cool thing is, because it's inside of an IUL, it's tax-free. But you have guarantees that you can't lose. So we're going to go to the wisdom table here, and I'm going to share this on the wisdom table. And I'm going to show just one of the insurance company's indexing strategies. This is called the multi-index. So all of these strategies, most of them are 1 year, like Doug mentioned. There are some 2 and 5 year, but this is called the multi-index, one of our favorite companies here that we use. But basically, we have a guarantee of zero's the hero if the market goes down, but you have up to a 13% cap in this strategy. And this includes the NASDAQ 100, the S&P, and the Dow. This is called a monthly average strategy. So it's kind of cool. But look at this last year. So last year, monthly, not point to point, but monthly average of the NASDAQ was about 16. This is back in January, by the way. This is January, or we're using January 15th as a date. But that did 16. This one did 15. The Dow did 8, and they take 50% of the best, 30% of the second, 20% of the third, and that would have been 14%. So we get our cap of 13. So what indexing is you don't get all the growth of the market sometimes.
Right.
We're capped at 13, but the insurance company's not keeping the difference. Everyone always thinks the insurance company's keeping the difference. Okay, the insurance company, your money's invested into bonds, mortgages. The insurance company's making 5, 6, 6.5% right now
in their general account portfolio portfolio is what we call it.
Yeah, with their billions of dollars, that's what they're making that kind of return, and they're just taking the interest on that money and buying options and hedging with the S&P or these indexes. Okay, I know that was a lot. In our book, chapter 6, we explain this more. But bottom line, they can make up to 13. They're not going to make more. But here, when the market went up 22, still only 13, but it goes down negative, you get 0. But look at this. The monthly average strategy, historical compounded average, okay? The last 20 years was 6.5. The indexing, we did 7 in this strategy.
Wow. So it was higher than what the actual market would have done with these parameters.
Without risk.
That's amazing.
Okay, 7, we did 8. 8.5, you did 9. 7, you did 9. These are all tax-free. This is the average returns we would have earned. Now, let's go to another one. Now, the S&P. S&P is going to have like a 10.25 cap. So this is only S&P. Now, this is point-to-point, where we're taking January 15th of 2023 or 2024 to January 15th of 2025
Just
down
one
here.
index, very simple.
Yeah, so 24%, you get cap at 10.25. Okay, 19, 10.25. Negative 14, we get 0. So this one, more conservative. But, about 7 to 8% the last 5, 10, 15, 20 years. Yeah, the market beat us in some of those dates, right? But we did this without risk. We got there like negative 38. We have 0, but other years get 10. Great, conservative, safe. Now, you want to be a little more aggressive? This is one of our favorites. Emmer and Doug talk about this one a lot. This is one of our favorites, the uncapped S&P. It's like, all right, because of the hedging and indexing strategy, market goes up 24. They take 6 out the top. Now, that's not a cost. That's not like the insurance company keeping 6% or it's costing you 6. Right. It's the way the hedging and option strategy works.
Strategy. It's called a spread. It's not a fee, though.
Yeah. So market goes up 24. You take 6 out the top. You get 18. Goes up 19. You get 13. Negative 14, though. What do we get, guys?
0 is my hero.
Yep.
So you don't lose on down years. And like Emron said, your
good
gains.
voice, Emron. My goodness.
Yeah, singing. Your gains are locked in every year. So you don't lose in a bad year. You reset and lock in those gains. So now look at the last 5 years on this one. 11.5. Wow. So if you're more bullish, choose this strategy. You would have earned 11.5 tax-free the last 5 years. Not quite as good as the market, but without risk, I'd do it.
Pretty good, right?
I would do it not to have that negative 14.
Yeah.
Okay. And tax-free. So if this is tax-free and over here on the left is taxable, is it better? Yeah. Okay, but look at the last 20 years. Okay, 8.8, 8.4, and this was with risk on the left, taxable. Ours is 8.8 tax-free without risk.
Right.
Pretty darn powerful when you look at that. And we can keep going. Like if you want, you could even get some with higher. Like here's that same multi-index. You could pay like a 0.8 fee and you can get a cap of 25. So now our averages are 8 to 10%, 8 to 10.5.
Wow.
Just awesome there. So there's, I'll show one more. And then you can have a high cap S&P. So you can get a cap up to 13 on the S&P, get a little bit more. Just giving you guys a taste. Basically, the bottom line is, though, guarantee of 0 the hero. When the market goes up, you lock in your gains, tax-free. This is indexing. This is what gives you, peace of mind at night. You don't, if we have that crash coming soon, when it happens, not if, but when, I don't know if it's next year. We don't have to guess that.
Yeah.
You don't have to guess that. It might be 2 years, might be 3 years, might be 6 months, might be 1 month from now. We are not going to lose our gains that we got the previous years.
And I love the point that you made about, you can look at a big chart over 20 years and go, ooh, I want that one versus this one. But also when you're living it and you're in a year where the market crashes and goes down 15% or 20%, it's a different thing than when you're living in it going, hey, I get 0 instead of that 20% downturn, rather than just looking at a chart and pointing, oh yeah, I want this one. But it provides a lot of peace of mind. Brandon, Aaron talked about a lot of these indexing choices. Do most good IULs have a lot of choices like this, or how does that work? Do IULs give you different options of indexing like he's showing?
Yeah. So it just depends on carrier. Each carrier has for the most part S&P 500 and maybe some variations of it. And really good carriers will have maybe a more complex suite of indexing accounts. But I think going back to what Aaron is showing is that really you don't have to be like super anxious what the market's going to do today.
Right.
If you are diversified, if you have some money inside of these kind of vehicles where you do have indexing and you are protected, because when you look at it from like a 20-year, more of a biopic point of view, rather than just like hyper focusing on what's the market going to do today. Because if the market's going to crash today and all your money, all your retirement account is in the market right now, exposed, that's an anxious way to live, right? Thanksgiving dinner doesn't taste as good. Christmas isn't as merry, right? And so if you do have a good portion of your money or a good chunk of your assets that are in an indexing account like this, or strategy, as Emran talked about, it's a strategy, then you can kind of look at historically, okay, a 20-year look back, I'm averaging 8%, 9%, 7% on these
Tax-free.
in these accounts. Yeah. So I'm a big like, let's look at the averages, and I can go to sleep with that peace of mind, knowing that if the market does crash, some of my money, okay, so I got a zero.
Yeah.
I get a zero.
So much
And
peace
you
of
saw
mind.
in those 20-year look backs, there was 2 or 3 zeros sprinkled on every index account, but it still was averaging 7, 8, 9, some of them over 10%. That's indexing. That's the strategy.
Yeah, that's great. I love that. Very, it's myopic and hyperopic. It's very verbose and loquacious of you.
Biopic. Thank you.
Oh,
It's a
brother.
long-term point of view.
That's very impressive.
to take, which is what you want. You don't want to make knee-jerk reactions just because the market crashes. Say, oh shoot, what do I do? Panic, panic, panic. Right?
It's great. I love it. All right. Well, coming up, our comments of the day. But first, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe and ask us a question or comment. Heck, we may use it in one of our next shows like we're going to today. Will future taxes be lower, the same, or higher? Now, for our audience, I want you to answer this question in your mind, or put it in the comments if you think taxes in the future are going to be lower, the same, or higher. This may be a little bit of a loaded topic, but income taxes rates have, let's just say, varied greatly over the U.S. history. Here's a chart provided by the Bradford Tax Institute, which shows the highest marginal tax rates going back to 1913, when the income tax code was first introduced. This shows that at one point, the highest marginal tax rate in U.S. history was at 94%.
So
Can you imagine? That was around 1945, at the end of World War II. Okay, my question for all of you, and Emran, we'll start with you, is will future tax rates be lower, the same, or higher?
How much time do we got? I mean, if we really look at this, I am actually going to go back to the wisdom table to kind of walk through this if we want. This is a great question because, I mean, the challenge is you've got a lot of, and I guess I'll ask the group as a whole. If you look at most politicians, Doug, are they hyperopic or are they myopic?
They're very myopic.
I agree.
Let me simplify. It means nearsighted versus farsighted.
Okay.
Again, because of that, though, I mean, a lot of politicians are looking at, they don't look at, they lack the ability to see how we can, like you often talk about, hey, can we raise the amount of revenue to be taxed rather than just looking at the current situation? So let's just lay out the current situation we're in right now. So the current situation we're in right now is the fact that we have, if we look at the national deficit, actually, I guess I'll hurry and just pull up a quick shot of that right there.
Oof.
That is the national debt clock right there.
That's painful. It's 38 trillion?
38 trillion.
Didn't we just do a segment? It was 37 trillion. Now it's 38.
38 trillion.
Wow.
38 trillion. But then you look right there in the middle one, though. I mean, so you got 38 trillion. And then one thing I do want to point out is the deficit spending. The deficit spending is about 2 trillion.
Yeah.
Okay. So I want to make notes of those 2 trillion. And then we've also want to make note of the unfunded liabilities. The unfunded liability, $105 trillion.
That's on the left side in the middle.
Yeah.
Okay. So that's, I mean, if you want to know if you want to get to where you want to get to, you got to know where you're at. So again, if we know where we're at, the first thing that we've got to, that they've got to figure out, that they're trying to figure out, is how to overcome the $2 trillion in deficit spending.
Okay, 2 trillion.
So we got $2 trillion right there. Now, again, if they're currently collecting $5 trillion.
All right, that seems like plenty.
No, but they're short. Okay? So they're spending $7 trillion, right?
Right.
Okay. So they're spending $7 trillion, and I don't know why the marker's not working as well right here, but they're spending $7 trillion. They're only collecting $5 trillion, so they're $2 trillion deficit. That's almost a 50%. In order to bridge that gap, that's a 50% difference there.
Yeah.
So that means you would have to increase current taxes just to cover our spending. We haven't even talked about unfunded liabilities yet.
Right.
Just to break even on our spending.
Right.
That would mean you would need to raise current tax rates by 50%.
Just to not go in debt more.
Yes. Just to try to maintain the status quo, you're going to have to increase tax rates by 50%.
Jeez.
Okay?
Just a little bit.
And then beyond that, though, the bigger problem right here is that we're seeing, and as we're going to see it more and more, is the unfunded liabilities. So again, the unfunded liabilities were what?
105
trillion.
And maybe for our viewers, unfunded liabilities, the biggest would be what?
Social Security and Medicare.
Yeah, welfare,
Medicaid.
Yep, social programs.
It's social program, yeah.
Yep.
Okay, so $105 trillion. Now, I looked at it and did some research here to find out, well, what do we have to pay $105 trillion as they're looking at it?
Yeah.
Because the myopic view is they are looking at this, and the one proposal, this was a proposal just proposed in the last presidential election. Okay, to be able to try to wipe this debt out or to be able to cover this, and the myopic point of view on this, though. I mean, they looked at it and said, okay, we've got we actually have 45. Okay, we've got $45 trillion in retirement accounts right now.
They have not been taxed yet.
Yep. Let's go after those.
We have 77 trillion in real estate holdings. We have 52 trillion in stocks.
I don't like where this is going.
And
these are all
25
privately owned real estate stocks and accounts, right?
Yeah.
25 trillion. I can't get that last one to right there. 25 trillion. Just trust me, it's there.
Yeah.
25 trillion in land. So you add these together here, and that's $200 trillion. So in order to cover $105 trillion, they need to seize
Half of everything we own.
Half of everything. Now you think of like, well, geez, that seems kind of crazy. But again, the last presidential election, there was a proposal to do this. I mean, there was a proposal to do this.
Biden's administration did
yes,
kind of
Biden
hint
and
at
Harris,
that they wanted to go after unrecognized gains.
Exactly. One of the biggest thing they looked at was right there was going ahead and saying, hey, look, we're going to raise the tax rate from 37 to 39. Saying like, oh, we're not raising taxes by that much. It's not 50%. It's only 2.6%.
Right.
Okay. That they always try to, eye candy over here, sleight of hand is what they're really doing. So what is the real sleight of hand? Yeah, they raised the Medicare tax also from 3.8 to 5%. Okay, that's what they focused on. That was like the two biggest bullet points. And then they kind of made these bullet points that you always look at the legal jargon. It's always in what? In fine print.
Yes. Yeah.
So let's read the fine print here. Okay, if you have income over $1 million, if you have income over $1 million in any given tax year, in that given tax year, you're going to have to pay 44.6% taxes on any unrealized assets.
Wow.
So if you have a house that went up in value, you got a house that went up in value, now it's worth, let's say you got $1 million of growth in your real estate. Your real estate has grown by an extra $1 million. If in a given year you got $1 million income, you're going to have to pay $444,000 in taxes.
Yeah.
And most Americans are like, well, yeah, but I'm never going to have $1 million income. Wait a minute here. Because they also looked at and said, we will also, here's the sleight of hand as well, we will also remove the step up in basis.
Oh.
Yep.
Ouch.
So you remove the step up in basis. So now you inherit, like I've got a family. There's not like they're like extremely wealthy family. They've just been savers. They've been, and he's got a property, It's worth $3.5 million. He originally bought it for $70,000. I don't know how many years ago.
Yeah. Right.
Okay, so it basically has $3.5 million gain in it. Right now, the way the law is written, if he dies, his kids get a step up in basis from 70 all the way to $3.5 trillion. But if they get rid of that whole $3.5 trillion, not $3.5 trillion,
expensive property.
Million, yeah.
Yeah, $3.5 million all becomes gain. Now, when that becomes gain and becomes income, that raises your
that raises your tax bracket.
Raises that all counts
just-
towards
yeah,
income.
yeah,
So
counts
now
towards
all of a
income.
sudden you have 1 year where you inherit. Now that year you have an inheritance, you are in $1 million tax bracket. You have $1 million of income that year.
Ouch.
So now all of a sudden
That's sneaky.
Oh, it is
Uncle
sneaky.
Sam will bite off half of that.
So that $3.4 million property the kids inherit, they're going to have to pay $1.5 million in taxes on that.
Right.
But then if the kids had their own real estate and stocks and unrealized gains of $1 million of their own, they're going to have to come up with an extra $446,000 on their own assets that year to pay tax. I mean, if they didn't have it, they'd have to sell their own stuff, whatever, in order to pay that. And that's also assuming they don't lower the estate tax rate.
Yeah, estate tax.
If they lower the estate tax rate back down to even $3 million or $1 million, the entire estate of that property could actually end up being subject to estate taxes, which would be another 40%. So you go on a $3.4 million, you could end up owing 89.6% on the inheritance. Plus, because you inherited it that year, it's going to cause your own assets to also become taxable, which means you will end up having to sell some of your own assets just to pay the taxes on your money plus the money you inherited.
It's like Doug always says, they try to tax it all, get it all taxed before you die, so they can tax you again when you do die.
I mean, if you really go through the detailed numbers of this, it is absolutely just insane.
And you could argue that, okay, well, they didn't actually get that, right? They didn't pass that. But
they didn't
it
pass it.
shows where their hearts are at.
Correct.
They
That's what
start
they
off-
are wanting to
Yeah,
do.
they start off
At
small and
least
they
Yeah,
almost
and
50%
incrementalism,
of the
right?
American population are thinking with this myopic point of view.
Yes.
Yep.
And you go, and that will, if you did this would absolutely destroy the assets and across this entire country. I mean, we would absolutely eliminate wealth out of this country, and companies would go under.
Well,
it would be absolutely crazy.
Because if you think about seizing half of people's wealth, right? Well, what does that mean for jobs, for economy,
Correct.
for growth, for GDP? Like all of that just goes down the
sell-off,
toilet.
right?
Yeah.
A massive sell-off.
Yeah, exactly. That's fascinating. Aaron, we talk about, IUL and tax-free. Why is it that life insurance or IUL or index universal life is given this kind of ability to have tax-favored status or give tax-free income?
To keep it simple, basically life insurance, because it is life insurance, under the sections of the code 72E, 7702, 101A, money, and this has been in the tax code since 1913, right? So since it was written, life insurance is tax-free because it was there to protect families. So when you buy life insurance, you still have to qualify for the death benefit based on income and the needs and what we call insurable interest. There needs to be a need and a reason to insure that person. And there's many reasons, but you can still be single. Don't think that you can't get insurance if you're single and have no kids. You can still insure your estate and have an insurable interest in your estate. But bottom line is, because life insurance is, there to protect the family and so forth, life insurance has always been protected in the tax code to be tax-free. So that's why we have all the wonderful features that has been tax-free forever. And it's one of the only tax-free vehicles out there. So all these taxes everyone's talking about, they still do not come after life insurance. And I don't think they ever will. You can't say, they can. They always could, right, you guys?
Yep.
But they never have touched it because life insurance has always been tax-free. So that's why it grows tax-free. We can get money out of it tax-free. And we die, it still transfers income tax-free. Still inside your estate, but all to income tax-free, which would avoid, all those income
Well, and
taxes.
according to the Constitution, if they try to come out, the Constitution states if they do, they could only go after anything dated after that, right?
Yes.
If
a good point.
If we uphold the Constitution of this country, then they would not be able to go after anything that exists there.
Yeah.
And the thing is you're buying a policy, you're buying so much insurance for how much you're putting in, you're complying with the 5-year law, all to keep it tax-free. So yeah, we should be grandfathered because you're complying with all those laws that allow it to be tax-free.
Yeah, that's awesome. That's great. Brandon, we've talked a lot about tax diversification. What does it mean to be tax diversified?
Sure. I mean, every financial asset or vehicle has kind of a way in which it's taxed, right? So for the most part, like people are familiar with IRAs and 401ks that grow tax deferred. But when you start to receive that money in the form of a withdrawal or distributions, it's taxable, right? It's taxed as income, ordinary income. And then you've got brokerage accounts that grow essentially you're going to be taxed on the gains or earnings, right? So you've got capital gains taxes. And so I think it's important that you think about a scale. Like a lot of Americans have the scale kind of like this, where all of their assets or retirement assets are tipped heavily in the favor of taxable income. It's
They're
IRAs and
lopsided.
401ks. They're way lopsided. So we're trying to help people to be a little more diversified and said, hey, why don't we take some of the money from here? Let's balance it out and get you some tax-free buckets, right? So the IUL, like what Aaron was talking about, because of the tax codes, the tax laws, we can take advantage of these awesome tax-favorable vehicles like a max-funded IUL. And now you're more balanced, right? So the scale's not so tipped heavily in the favor of all taxable income in retirement.
It's called smart.
Smart diversification. Yeah.
Yeah, that way you got like you can have some taxable income, but you're not in the higher brackets because you have some of the money coming out from the IUL tax free.
Yeah, and if your
Right.
target income in retirement is whatever number it is, if it's 150,000 and you look at your portfolio and you say, gosh, this is all going to be taxable, all 150,000, that's going to keep me in this higher tax bracket potentially in the future if taxes are going to go up.
Right.
But if we can alleviate that and say, no, let's get half of that tax-free, and then the other half is just taxable. 75,000 is taxable. 75,000 is unrecognized as taxable income. Keeps you in a lower tax bracket. Maybe you're going to be in a 12 to 22% tax bracket.
Yeah.
So
just to be clear, on the record, do you all think that future taxes will be lower, the same, or higher?
You know, they're going to go higher, baby. They're going to go higher.
the government has an insatiable appetite to spend money higher.
Grow and grow. By the way, that chart originally, I think when it was first introduced, federal income tax was like at 6%.
Yes.
The highest rate
that's
was like
correct.
6%.
Wow.
Yep, 1913, it was at 6%. Yep.
And then it just went, boo. Okay. All right. Douglas, what say ye? Will future taxes be lower, the same, or higher? And what are your final thoughts on this segment?
How far in the future? Myopically?
Or hyper?
Hyperopically. Okay.
Biopsy.
Yes,
No.
yes, and yes. All of the above.
Trump, if he keeps the 2017 tax cuts till the end of his term. So for the next 3 years, they could potentially be the lowest tax brackets many people
Which
will,
we
will
should
ever be.
expect. That was
Yeah.
the
We
big,
should expect
beautiful,
that.
big, beautiful
Which-
bill.
which-
Next 3 years, we're probably okay.
Yeah.
Yep.
Yeah.
And if you don't use the room in a 22 or a 24% tax bracket, you will lose it.
That's right.
That's why,
point.
you know, when they expire, it's not a matter of if, it's when.
Right.
Okay. The 22 goes to 25. The 24 goes to at least 28. And people say that's just 4%. No, on $240 of if you have $1,000 and you're taxed on it at 24%, okay, that's $240. If you pay now $40 more than that, $280, $40 is 16.66% more money. It's not just 4%. And so it will be one of the greatest tax increases. So in the long run, most Americans agree taxes will likely be higher. That's why you should act while they're lower. And so knowing that, because of the deficit spending and what Trump tries to do as a Republican, he tries to raise the revenue that's being taxed to raise tax revenue. But what happens? We experience that, and the economy, like we started talking about in this podcast,
Right.
starts to do well, and then the tax revenuers come in and
Yes.
say,
More,
let's raise
more."
taxes, let's raise taxes.
Exactly.
And I think it's going to be very interesting to see Mom Donnie,
Yes.
the mayor of New York.
New York, yep.
I mean, I thought it was interesting how Donald Trump and him got together to try
Yes.
to temper things down
It's
for things,
fascinating.
for the holidays, okay?
Right, right.
But it's going to be interesting because their viewpoints of how to take care of the homelessness in New York and affordability and all that. And Mom Dummy wants to give free buses and everything. Like, where's the money going to come from?
Right,
Okay.
right.
So he wants to tax the rich. AOC's right there. And I think Trump's going to say, we'll see. We'll see if that's the best solution, you
Yeah,
know?
yeah.
Because if you just go out there and tax the rich, they're already deciding to leave New York. And all of a sudden, it starts to implode. The whole system.
Right.
The people who they're taxing, the people who have the money, if they say bye-bye, they're going to have
They
some
might be in
issues.
trouble.
Yeah.
So.
Yep.
All right. Well, coming up, we react to your comments on the Kyle Busch situation. But first, if you're enjoying this content and are wondering how to take advantage of these ideas, L.A.S.E.R Financial helps individuals and families like yours implement proven strategies to grow and protect your wealth. One of the most powerful tools is an indexed universal life policy, or IUL. It's not just insurance, it's a tax-free retirement strategy, a way to grow your money with compound interest and a safety net against market downturns. Imagine being protected from market losses while still participating when the market goes up, and having tax-free income that allows you to keep more of what you've worked so hard to save. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. That's laserfinancial.com or call 801-505-0409. Don't wait. Take the first step toward a brighter, more secure financial future today. Are you a financial professional wondering how you can expand your business working with IUL? Are you leveraging IUL to its full potential? That's where IUL Insiders comes in. In the upcoming weeks, they're hosting the IUL Challenge. It's a free 3-day event designed specifically for financial professionals to help you build a thriving, scalable business that sets you apart from the competition. You'll learn proven strategies to market, design, and sell properly structured policies that deliver incredible results for your clients and for your bottom line. If you're ready to elevate your practice and scale your business, visit IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. Comments of the day. One of our more recent shows was a special edition that was 100% focused on the Kyle Busch situation, where he and his wife purchased an IUL, and it appears that, as we glean more information, that the policy was indeed structured wrong, funded incorrectly, and managed poorly. Here's a few comments we received from that show, including Ayana, who said the educational approach is the best approach. I totally agree, Ayana.
Yeah. Education is power, right?
Yeah.
Knowledge is power.
100%. Absolutely. JB Jab says the guy who designed Kyle Busch's case was either incompetent or a dishonest guy. I would add allegedly, okay? Looking to rip him off. Guys like that make a great product look bad. I have seen countless people get incredible results with IUL.
Me too.
Art B says, most likely the agent designed it where his intent was to get more commission, and that's why it blew up. The policy, allegedly. He says most likely is what he says. The policy might have been designed where there was a high death benefit instead of high cash value. Yeah. Gentlemen, obviously there are still many details. We're still trying to get more and more concrete
the actual information,
details, right?
You need the information.
And I fear that that's going to be long time coming.
Right.
So please be patient, because we do want to talk about this more, because honestly, this is the heart and soul. We don't have anything to do with the agent or the situation or anything, but this is kind of the idea of IUL and the heart of soul of it and the attacks on it. So we're still getting more information, and we're waiting for more of that. But what are your guys' thoughts, with some of these recent comments, and as a little bit of time has passed since the IUL, since this kind of Kyle Busch situation? Aaron, let's start with you.
Like they were saying, I think the education is the key, like the first comment, right? And in the book, the L.A.S.E.R Fund, sitting over there, on the desk there by Doug, is we've done a really in-depth analysis of IUL to really help people understand. And I think that's what needs to be done in the industry. Yeah. I mean, that's why we have this YouTube channel. That's why we have this podcast.
Right.
Is we are able to teach and educate people on how IUL is designed, how you design it, how you structure it right with the lowest debt benefit and the most cash going in, and disclose all the fees and expenses and how it works. Help people understand how it works. This is where at L.A.S.E.R Financial, like we were saying, this is where we go through clients one-on-one. We go through all the line items, help them understand the indexing, the benefits and so forth, because IUL can be complex at first, but it really can be more simplified once you just take some time to learn and educate yourself on how it works.
Yeah, I love what you said, because I am amazed at how much has been put into that book. I mean, this book There is so much that's put in here. All the details, like you said. And if you're out there and you're going, I don't know about this and I want to know all the details, right? I'm an engineer. I want to know every detail. I want to know how it works. I want to know all the little bits. It is amazing how much is in this book. And you can go, we didn't plan this, but I think it's laserfund.com, right? That you can go to get a copy, just pay shipping and handling. It is amazing. Emran, what are your thoughts?
I'm all over this myopic word right now, right?
Myopic, hyperopic.
Right. Obviously, right
discussion.
now I think we do have a myopic view of this case.
Yeah.
Right? We only have a small amount of information.
Right. Limited.
But again, as you're looking at it, I mean, there's lots of things that go into this as well. I mean, one, you've got somebody in a very risky career, race car driver, professional race car driver, driving at over 200 miles an hour constantly, consistently. I mean, that's usually not considered. I know when we fill out an application,
kind of a hazardous profession,
you have
right?
to mark that on the box right there, and it's gonna, there's a death. This is a life
How
insurance
much
policy.
was the death benefit?
Right, the death benefit.
know?
I don't know. I mean, I've seen alleged numbers in the realm of like maybe even 40 to $50 million.
Yeah, that's a lot, and there could be some additional fees because of that kind of hazard.
Because of that high risk,
high
hazard.
risk.
They're
Right.
called flat
So
extras.
regardless, though, I think that the point of this is, again, if this is your serious cash, knowledge is power. And correct knowledge. Correct knowledge is power. So it can empower you. I mean, one, I would look from this, look at this, and I would absolutely learn from it. It's easy to learn. We always learn from our bad experiences even more than you learn from your good experiences.
Right.
So if somebody has a bad experience, well, why did they have that bad experience? Oh, well, is it easy to avoid it? How easy is it to avoid what we are seeing right now, the potential pitfalls of Kyle Busch and his case and the agent and everything? How easy is it to avoid those pitfalls?
Right.
Ridiculously easy.
Really?
Yeah.
I mean, once you know them, you can avoid them.
We'll
you
probably
can
do
avoid
some
them.
kind of top 10 reasons show down in the future.
Yeah, once we get more information,
once
we'll
we
look
get
at that.
more
But once you know it, man, it is so easy to empower yourself to avoid these pitfalls.
Yeah.
It's not hard.
Yeah.
It is not complicated. It is
Right.
not overwhelming. It is so easy to avoid the pitfalls and do it right.
Yeah, great point. Brandon, what are your thoughts?
We obviously aren't privy to all the conversations that happen between this agent, Kyle, and
Right.
Kyle's wife, right, Mrs. Busch. And so
What their actual concerns were.
Yes,
I
I mean, death benefit concerns,
if,
right?
if it was
Right.
40, it sounds like it was maybe 40, 44 million, something like
you
that.
cannot get an IUL without
Yeah.
some kind of death benefit need and want.
Yeah,
To
and
what
and
what
the risk of
extent
me
was
dying.
that?
I mean, if I were to die, I wouldn't want my
And
wife to be
Well, and if you're the
taken care of.
spouse and your husband is in a really high risk, like
Occupation.
intense occupation where one wrong mistake is like the end.
Yeah.
Or even somebody else's mistake.
$44 million check comes. So yeah, that's a huge risk that an insurance company like Pacific Life or any carrier out there is
Right.
willing to take. And so there's a cost that comes with that. At the end of the day, it is death benefit. It is life insurance. Now we teach people again through the Laser Fund. We're structuring in a way where most of our clients are wanting to maximize cash accumulation. They want to maximize income distribution or passing cash on to
They
family
want to
members.
self-insure themselves.
They want to self-insure. And so, yeah, what we weren't privy to all the conversation. What was the need, the purpose of this policy and how it was structured. And so all this stuff will come out. And so a lot of it is speculation right now.
Yeah, and that's a good point. Sorry to interrupt, but there's a lot of YouTubes and videos and people kind of opining on this.
Yeah.
And they're really coming out hard, and really making a lot of assumptions.
The
Would you
speculation is
agree?
probably 3 standard deviations away from the reality.
You're not a kid.
It's very what do you call it? It's very overpriced speculation. Okay.
Exactly. I mean, the speculation is way out there.
Well-
We'll find out what reality really
So
is.
I really like that, Brandon. Everybody out there, just take a time out, make sure that we're not just speculating, and that's kind of what we're trying to do. There's certain things that appears to be, and obviously that reinforces everything we teach: structure, management, funding, all those kinds of things. But we still want to get additional details to come.
Yeah.
Doug, wrap us up. What are your final thoughts on this subject?
Yeah. I think we're still very premature because we don't know the objective. If Kyle and his wife were primarily interested in a death benefit in the risky occupation of an NASCAR driver,
right.
and heaven forbid if something would have happened to Kyle and the death benefit was 40 some odd million, Pacific Life would be a hero. Okay.
Oh, yeah.
But we don't know. Was Was that just a secondary objective, a primary objective? Many people, as Brandon said here, they come to us because they want to use max-funded IUL as a living benefit, okay? Tax-free accumulation and tax-free growth. If that was their primary objective and death benefit was secondary, well, we're beginning to see, the amount of premium they paid in, if it was max-funded properly and structured correctly, your premiums paid in the first 4 or 5 years, which is the time frame we're looking at, could easily equal the cash value. And apparently the cash value isn't anywhere close to the premiums they've paid in.
Right.
So that tells us if that was the objective, it was not structured correctly, nor funded properly. So I'll go back to sort of my metaphor. I would hate for Mr. Busch to just say all IUL is horrible because of this experience, which we don't know for sure why it was structured the way it was.
That's like losing a house is a bad, like says real estate is a bad experience because somebody once lost a house.
Right. Yeah.
I mean, if somebody, again, a mechanic, I said in the previous episode, if somebody sold him an engine and said, this engine is a winner for you, but they didn't build it right.
Right.
And they didn't fuel it properly. And so it didn't perform. And for him to say, oh, well, that's it. I'm not going to buy any more engines would be ridiculous. Okay.
Yeah. All cars are
IUL structured correctly, built properly, and funded, fueled right, can be an incredible engine that creates wealth. We just don't know enough. Yeah. I feel bad for them. And once we know more, maybe we'll be able to ascertain what the real issue was.
And an IUL is a complex financial vehicle. So you want to work with a specialist or somebody who really understands and knows what levers to pull to make the IUL perform the way that it's supposed to perform, if that's what you want.
Amen. That's laserfinancial.com. All right, that's all the time we have for today. Protect yourself from market crashes and future taxes. And we'll see you next time on 93 Million. Thanks everybody.
Take care.
Thank you.